Okay, so one more section in 17 is going more into some analysis with some more financial ratios. And if you do pay attention to anything financial, if you watch financial news on TV or anything like that, you're probably going to hear a lot of these terms when it relates to different businesses. So really what we're going to do is we need to figure out all of these items: earnings per share, dividends, yields, price earnings ratio, working capital current ratio, and quick ratio. So we're going to use this space down here to do the math, and hopefully I can get it all on this little section. Okay, so we're going to start with earnings per share. Okay, and what this is net income after. I'm just going to do it this way because hopefully you'll know. That's after taxes, right? Divided by the number of shares outstanding. Okay. So we've got this in our book. Net income after taxes is 148,186.18 divided by the number of shares outstanding, which is 40,000. And again, all these numbers are given to you in the book. Okay, so this should equal, if we do that math, 3.70. Okay, so 3.70 can come up here. All right, so there's that one. And then the dividend yield okay, this one is the dividends per share. Well, I shouldn't do that. That could be confusing. Dividends per share divided by the market price. And again, this stuff is given to you in the book. So dividends per share is $2.48 divided by the market price of $37.90. Okay, and that equals 6.54%. Notice we've gone to 2 decimals here. Okay, the price earnings ratio you know what, I'm going to back up for a second because I think I want to put something else right here before we do that. Sorry. Okay. So on this dividend yield, if this number is lower, well, let's do it. If it's higher, the higher this number is, that can be labeled an income stock. And if this number is lower, they call it a growth stock. And what that is meaning is that some stocks that pay dividends pay a lot of dividends, right? So they're getting, a lot of their profits back to their owners through dividends. Whereas if a company is keeping more of that and not giving it as dividends to the owners, that means they're reinvesting that into their company. And so then it becomes a growth stock because that company is focused on growing overall and maybe not necessarily giving a lot of money back to their owners year after year. Okay? So then when we get to the next one, which is the price earnings ratio, the opposite is actually true. Because this is looking at how much are you making off of the price of the share compared to the price of the share, not compared to the dividends per share. Okay, so this one's going to be market price divided by earnings per share which we have right there, right? Okay. So again, the market price was given to us at $37.90. The earnings per share is 3.70. We figured that out. Oh, this is not percent. Oh, that's a dollar amount. Okay. Yeah, earnings per share is a dollar amount. That's percent. Okay. That would make more sense here. Okay. Then, so that number is 10.2. Okay. And you may see this just listed as PE, the price to earnings ratio. Again, if you're watching or reading things. So again, now this is lower, it's considered an income stock, versus if it's higher, it's a growth stock. Okay? Just some little tidbits there. Make sure you can see that. All right, so then we'll put this up here at 10.2. Okay, and then let's go ahead and figure out these actual ratios here, and then we'll keep going through the analysis. So the working capital, I'm gonna have to give myself some room here. Is the current assets minus the current liabilities. Okay, and again, our book is going to give us these numbers. So 604,984.00 minus current liabilities of 418,493.00, and that's going to equal 186,491. Okay, working capital is basically, just taking your assets minus your liabilities, and focusing on the current, right? Not your long-term liabilities, not your plant assets or your long-term assets, just the quick stuff. What could you, looking at your current assets, if you could you cover your liabilities, and what would you have left, right? That's the working capital that you have. Okay, your available assets, I guess I could say, right? This is your available assets. Okay. All right, then, so actual working capital, 186,491.00. Okay. Not really a ratio, just a calculation. All right, and then the next one is current ratio. This one is a ratio. Okay. Okay. And this one is the current assets divided by the current liabilities. Okay, so using those same two numbers, just dividing them. So 604,984 divided by 418,493 equals 1.45. Okay, and this is your ability to pay the debt. And we talked about this a little bit in the other one with the debt ratio, but that included everything, right? So this is just a little bit quicker. How can you pay your debt a little bit quicker? Just looking at your current assets and current liabilities. Not worrying, you don't have to go sell buildings and sell vehicles and all that kind of stuff. It's just, what cash do you have in the bank, right? What are some of the, office supplies that you could get rid of real quick, or things like that. Okay, and then the next one is even quicker, simpler, I guess. I don't know how to say that, because it just wants to focus on things like cash, petty cash, and accounts receivable. That's even quicker. Like, what do you have in the bank that you could cover your debt? That's your quick ratio. And so again, that number is going to be given to you in the book. So, let me actually write this down. Quick assets divided by current liabilities. Okay, and this is going to be cash, petty cash, and accounts receivable. Okay, because those are the things you could take care of real quick. You could go call your customers and say, I need my cash now, right, on your accounts receivable. All right, so then number-wise, I'm running out of room. 484,943, again, given to you by the book, minus these same liabilities, 418,493 equals 1.16. Okay. All right, so we've got 1.45 and 1.16. Okay. All right, so let's jump up here. Again, we kind of talked about this as we went through it. How quickly can we cover our debt? What cash do we have available? Our working capital, how quickly could we pay our debt, pay off all of our bills? What would we have left, and that kind of thing. So again, we've got some acceptable ranges, and this is just a question, are we within our range? Yes, we're within our range. Nope, not on this one. And yes on this one. Okay, again, all these ranges can come from previous experience, previous years, managerial experience, comparative to industry, and things like that. Okay, now up here, they do want a little bit more information from you. So prior year to current year, was there an increase? Yes or no? So of course, yeah, that's a yes, right? That did increase. That actually went down from prior year to current year, and this one was an increase. Okay, so just an evaluation, earnings per share. yeah, we did increase. It was a nice little increase, so that's a good trend. Earnings per share is going up, right? That means that our market value is going up. And so, and actually you could give that, if you did a little division there, it could tell you that EPS increased by 13.5%. That's a pretty good number right there for an increase over prior year. Favorable trend. Sorry, I'm sure that's probably hard to read for you guys. Okay, dividend yield. So this one did not increase. So I mean, it's a small decline, right? It's not big, but it did decline. Okay, and that could tell you right here that this is probably more of a growth stock over a income stock, right? But we still don't want to see the decline necessarily. So that's an unfavorable trend. Okay. And then a little bit of increase here on the price earnings ratio. Again, looking at the market. So our market is looking favorably. So the market value is increasing, right? So this is a favorable trend. So just adding some notes in there. Again, you're probably going to have to, read through some things to kind of understand what kind of evaluation you might have to give on this, and really understanding what these are, as to be able to give me some kind of analysis there. All right, so that takes care of 17.4.